Hi everybody, and welcome to our last video in chapter 20, video number 11. And going back for a second here to the amortization schedule for a direct financing lease under an ordinary annuity. We'll go back all the way here. Here is what the direct financing lease amortization schedule looks like with an ordinary annuity basis. And now, if we take a look at the lease amortization schedule here, we see that Armand is going to report under a direct financing lease amortization schedule, Armand is going to report the following information related to the direct financing lease at December 31, 2025, either in the balance sheet or notes to the financial statements. And here it says our lease receivable is going to be $461,036 and our deferred gross profit will be $1,140 for a total of net lease receivable of $21,321.36 as shown here. Okay, give you a chance to absorb that for a second, and I'll go back here and go back one more slide here. Okay. So now Armand is going to make the following entry for 2026. It'll debit cash for $9,338.64 as shown. It'll have deferred gross profit of $667.85. And we will credit lease revenue here for $2,025.53 and credit lease receivable here for $7,990.96. Okay, then for 2027, we'll do something similar. We'll debit cash here for $9,338.64. We'll debit deferred gross profit for $462.15. We will credit lease revenue here for $1,330.39, and we will credit lease receivable for $8,470.40. And lastly, we'll make the following entry on December 31, 2027. We'll debit inventory to bring that asset back and credit lease receivable for $6,000 to zero that receivable back out. Okay, let's take a look at comparing accounting for leases under GAAP and IFRS. There's lots of similarities. One, both GAAP and IFRS share the same objective of recording leases by lessees and lessors according to their economic substance. That is, according to the definitions of assets and liabilities. Number two, much of the same terminology for lease accounting in IFRS and GAAP is the same. Number three, both GAAP and IFRS require lessees to recognize a right-of-use asset and related lease liability for leases with terms longer than 1 year. And number four, under both IFRS and GAAP, lessors use the same general criteria consistent with the recent standard on revenue to determine if there is a transfer of control of the underlying asset and if lessors classify leases as sales type or operating. And number 5 here, GAAP and IFRS have similar qualitative and quantitative disclosure requirements for lessees. Differences. There is no classification test for lessees under IFRS 16. Thus, lessees account for all leases using the finance lease method. That is, leases classified as operating leases under GAAP will be accounted for differently compared to IFRS. Number 2, IFRS allows alternative measurement bases for the right of use asset. And an example, the revaluation model in accordance with IAS 16, property, plant, and equipment. And then number 3 here, in addition to short-term lease exception, IFRS has an additional lessee recognition and measurement exemption for leases of assets of low value, i.e., e.g., personal computers, small office furnitures. Okay, more differences. The IFRS does not include any explicit guidance on collectability of the lease payments by lessors and amounts necessary to satisfy a residual value guarantee. Number 2 here, IFRS does not distinguish between sales type and direct financing leases for lessors. Therefore, IFRS 16 permits recognition of selling profit on direct financing leases at lease commencement. Number 3 here, the IFRS applies to leases of any asset, whether tangible, plant, property, or intangible assets. GAAP applies only to tangible plant property. And number 4, IFRS uses the same model for leases for both lessees and lessors, whereas GAAP uses a different model for lessees and lessors. And that is the end of Chapter 20. And when we resume, we will start with Chapter 21. Until that time, bye for now.